But they haven't really done it with commodities, and he's saying there could be some ramifications if that does happen.
So you're worried about the Reddit crowd getting involved in commodities right now.
What's going on, Penny boys and gals? What's going on, stock traders? It's your boy, What the Duck here, and it's time for another PB Reacts, where we react to videos that have to do with stock market trading on YouTube. So this video is actually a Paul Tudor Jones interview. Paul Tudor Jones is actually a hedge fund manager, one of the most successful ones in the world. We actually talk about him in Pennybois University during our trading psychology courses. But this video is about inflation and his take on what might happen in the future. He actually called the Wall Street crash back in 1987. So let's go ahead and see what he has to say.
Okay, so here's the real question.
Right.
If things are bad as crazy right now, and you are a trader, not necessarily even a long-term investor, but a trader, let's just say you're thinking about where to put your money. I'd actually love to hear about it in the context of being a trader, but also actually as a long-term investor. What are you supposed to do in this environment?
If I rewind just to 2011, when inflation was peaking at 3%, not CPI at 4.9. Those same investors had 1.2% of their assets, which would imply today, if they just got back to weight, another $400 billion of buying in commodity indices. And if you, certainly the impact models that we run would argue that GSER or BCOM would double or triple. So you've got, if I just look at where asset managers are, 60-40 types, the one thing that they should be invested in, they're not invested in, probably because they're hearing these assurances that inflation's transitory. So you've got this massive short, really, in the commodity complex, a massive short there. So that makes me think that, and I'll look at the balances in a variety of commodities, and they're all so razor thin. They're all so razor thin. And this is just what happens if institutional money would get to where they should be, given the level of real rates. What happens if the Reddit crowd ever gets into commodities? God forbid if the bullies, the financial markets, ever were to take it on, for instance, like retail did back in the 70s.
Explain what you mean by that.
What I mean is that commodities are finite supply, small markets, generally speaking. And if we ever get an inflationary psychology, like for instance, we did when I was in my 20s, back in the 70s, if we ever get that again, and if you ever got retail actually nervous about inflation, then the one thing that leads inflation, which is commodity prices, it's the easiest tautology there is, those things can literally scream double or triple with no problem whatsoever.
So for those who don't know, commodities and stocks are two separate things. Commodities are physical products, whereas stocks are represented by ownership. So, you own a stock, you don't actually physically have the stock in your hand. With commodities, they are physical products. And commodities are usually traded in shorter durations, meaning they are, bought and sold in a shorter period of time than stocks typically are. And commodities trade based off of the futures markets, so they could be a little bit more risky. So what he's saying here is that the AMC apes and the Dogecoin hodlers and the Reddit Wall Street bet type traders, they've been getting in on the stock market. They've been going pretty hard with the retail investor movement, or however you want to call it, with AMC, GameStop, and other stocks, and even Dogecoin, other cryptocurrency, and all those other altcoins and meme coins. But they haven't really done it with commodities, and he's saying there could be some ramifications if that does happen.
So you're worried about the Reddit crowd getting involved in commodities right now?
No, I'm saying that right now, I would be a lot. Look, I think I'm the most conservative investor in the world. That's a hedge fund manager by definition. Hates risk, loves edges, loves competitive edges, does great reward risk trades. I would be really concerned about arguing that inflation's transitory when I know that you've got. Look, think about it. We have a just-in-time mentality. We have inventories at record low. We have demand screaming, and we have people who are really underinvested where they should be, given the valuations of a variety of financial assets.
You said if the Fed doesn't make any moves this week, that it's going to be a green light.
Well, for me, it would be a green light.
But the question is, so it may be a green light temporarily, but you're also suggesting that there's going to be a hard stop at some point. that it's going to create an even bigger problem. And so how does a long-term investor think about that?
Listen, I have maintained, I'm so happy I don't have to run a pension fund. I don't know how you'd invest those assets when valuations for both interest rates and stocks are at, if you combine the two, they're so overvalued. They're at 100-year highs. I don't know what you do. I know one thing I'd want to do is the one thing that can hurt that is inflation. I'd have as many inflation hedges on as I possibly could. I sit on, the investment committee of these not-for-profits, and it's really difficult to try to explain to some of the board members of our not-for-profits, gee, maybe now's not the best time to be invested in a variety of finance. Maybe we should own commodities at this stage of the game. Right. Can I just say one last thing? The December 2018 meeting, if you think about that meeting that the Fed had, with pretty much the same board makeup, they had a lot of incoming data between that meeting and the one prior to that. Stock market was down 12%. GSCI was down. Commodities were down 20%. The credit markets were frozen. But they went on and hiked because they were locked in to this linear belief that I can have a forecast and that we should stay with it. That predictability was more important than reactivity. So I think they had the same, and 7 months later, they had to reverse course and take that back. I think we're confronted with exactly the same situation right now.
That's interesting that he mentions predictability versus reaction. So with predictability, it's people who think that they can predict the stock market. They try to get in really early based off of maybe some news that might be coming out or earnings or any kind of catalyst, that they might be able to get ahead of the crowd or get in on early. Whereas traders who are more in the reaction category, they might see a upward reversal. They might see some type of overbought signal, some type of indicator that could tell them that the stock is currently starting to reverse the trend. Or maybe some news just came out and now they're going to maybe either day trade the news, or if they're really confident, swing the news. These are reaction traders versus traders who are trying to be predictability traders, which is, like I just said, trying to get in before everyone else, trying to predict the market. It has a little more risk because, no one can really predict what's going to happen. It's a lot easier to see what's going on and react to it. But, those who do get in on these trends really early are the ones who make the big profits, which is what we do try to do in Pennybois stock alerts. We try to get in on the trades before everyone else starts pumping them up and talking about them. Like we had Dogecoin at 0.002. We had AMC when it was sub 10. It was like I think sub $5. We got in on all these early, and because of that, we made the most potential profit. So let's go ahead and see what Jim Cramer has to say about Paul Tudor Jones.
Paul Tudor Jones, though, I thought literally I couldn't stop taking notes fast enough because I thought everything he said was a roadmap for how we should be thinking about the markets this week with the Fed meeting coming up midweek.
I like to go over everything that's happening this morning with the research.
So the meeting that he is referencing is a 2:30 p.m. Eastern Time Zone meeting that happened on Wednesday, 6/16, June 16th, 2021. The Fed did speak. They spoke on inflation, and this video is actually coming out after that happened, but those of you who are watching this, you can now go back and see, all right, what happened to the market around 2:30 p.m. or right after they finished speaking, and also you can see, all right, what did the Fed say, about the market, about inflation, and then you can see how it might have affected the market, so that you can go back, for next time you can see, all right, well, last time the Fed said this, the market reacted this way, so let's see what they say this time and see maybe you can predict what might happen based off of what happened in the past, as opposed to just reacting off of the news and, scrambling with a stop loss or whatever it may be, after the news already hits. So, using the past to help predict the future is very helpful, especially, that's how charting works. The technical indicators, they're not telling us the future, they're telling us what might happen based off of the past price patterns or past price levels.
Papers, what people are saying, forget that. I stopped. I stopped because of Paul Tudor Jones, because he is such an influential person. I think anyone who's worked with him know he's a great person. And he did lay out a rather stark view about what's going to happen later this week. So for anyone who is trying to make sense of what can happen, he did indeed put it on a silver platter.
He teed up the debate so well as to what is taking place in the marketplace right now, what the Fed should do and when. Are things overheated or not? And what happens if the Fed actually does talk about tapering and acknowledge that they're moving closer? He says there's going to be a taper tantrum. All this against the backdrop of the S&P 500 at a closing high.
Look, if you listen to him and you listen closely, what he's saying is there probably will be a stay the course. And at the stay the course, he's all in the inflation trade. And we've got the ones that you need. I mean, you can argue it's Bitcoin, you can argue it's gold, or frankly, it's just go right back to Freeport, go right back to Caterpillar, go right back to Alcoa, which got a number bump today. Just go right back to those stocks, which is not what the market was doing last week. Those stocks cooled off. Take a look at Caterpillar. It's the one I really focus on, just as a kind of an analog, just crushed. And we went back to, yes, FANG. We went back, Apple just not, you just go back to call it FANG. But we were buying the drug stocks furiously, including ones that aren't doing well. So obviously, to me, the market is out of sync with what Paul Tudor Jones is saying, which means Wednesday is going to be incredibly dramatic either way. They either have a taper tantrum, market goes down, or we have a totally different trade that starts going higher from last week. I don't even know whether he knew what he was saying was as earth-shaking as it was.
He said that the NASDAQ, if the Fed, let's say the Fed does nothing this week and says nothing and sort of stays the course, he said the NASDAQ could go up another 20% from here. Just basically between now and the end of the year, because of the amount of buying that they're going to do.
Right, because what he's saying is, look, business is not going to cool down, and you can be in those stocks. I like a combination of the barbell of being, like our friend Stephanie Link.
That's right.
I want to be in the metals. I think those go higher. I want to be in certainly anything involving just rapid industrial. But he's also saying be in the semis, because that's what the NASDAQ is. And that group has fallen out of favor. My head was spinning. Because what it said to me was, somebody's going to be so wrong this week that the turmoil on a Wednesday in June, where people aren't even paying attention, the turmoil is going to be radical. And he says it in his usual calm manner.
Yeah.
But I was taking notes and I'm saying, oh my, Wednesday, I didn't think it was going to be that big a deal. So everyone kind of felt it's just going to be business as usual. He's saying it's not business as usual.
Anything but. So he said right now he's 5% gold, 5% cash, 5% commodities, 5% Bitcoin. Says, I'm not sure what to do with the other 80%. I need to wait and see what the Fed says.
So we always talk about having cash on the side, meaning, keeping some of your portfolio just on the side in cash or in your portfolio, as in, not in stocks, not in use. The reason being is in case something drastic happens in the market, like, way back in the day with, back in the day, a year ago, when COVID happened, if you had cash on the side, you could have reacted and got some of those dips and made some money, or when Apple or Tesla decided to do a forward split and everyone was talking about it, if you had cash on the side, you would have money to take advantage and trade those stocks and take advantage of those rises. Or Dogecoin, when Dogecoin, Elon Musk tweeted about Dogecoin. If you had cash on the side, you could have used that money to make money off of Dogecoin. Now, if you had all your money stuck in stocks, you would have had to sell some of your stocks you might not have wanted to sell and you weren't ready to sell. So Paul Tudor Jones said he had around 5% in gold, 5% in commodities, 5% in stocks, 5% in, I think it was Bitcoin, he said. So, he was pretty diversified, meaning he didn't put all his money that he had in the market in one basket. He threw a little bit in Bitcoin, a little bit in stocks, a little in commodities, which is something that we definitely do stress about and do teach in Pennybois University, diversifying your portfolio based off of what stocks you have, what types of stocks you have, like whether it be stocks or commodities or Bitcoin or gold or whatever it may be. We also talk about different sectors because you don't want to be very heavy in one sector. In case that sector doesn't do well, then your whole portfolio will go down with it. But all that is discussed in our 22 class trading program. But he said he had another 80% to spend, meaning he had 80% cash on hand, 80% cash on the side, because in markets like this, when it's really volatile and there's a lot of uncertainty, it's pretty smart to not put all your money into the market. It's smart to have money on the side so that we can take advantage of those reactions, to whether it be be inflation talk, or, whether it be reopening working out, or whatever, from COVID, whatever it may be, we can now take advantage of that with this cash on hand, whereas we had all the cash in the market, and the market goes down, well, we don't have all that much cash to either average down on or try to make money with on the rise up. Now we just have a lot of bags to hold, which is a possibility when there's a lot of uncertainty like this, especially a lot of bearish uncertainty. So, definitely keep in mind, having cash on hand is super important, and also diversifying your portfolio is equally important.
If anything, on Wednesday, and then I'm going to position myself accordingly.
Look, I found myself thinking, okay, but what's Tepper going to say? Because he laid out this agenda of who's interviewing people. You have Druckenmiller doing the interviewing. And I say to myself, I want people at home to recognize these are not the typical billionaires, and not the good billionaire versus the bad billionaire in the New York Times. Like, a guy like Tepper might just say, look, you buy the banks in this situation. If there's a taper tantrum.
Well, that's part of the reflation trade, is it not?
I think it is, but he may say, look, you want to buy him for volatility. You want to buy Goldman. Remember, he worked at Goldman. I just think that what's going to happen is not what's expected. And you've got to tune into his programs, to the conference. You've got to tune into the Goldman piece today, which says basically Jay's right. I'm with Jay.
So Jim Cramer was talking about the taper tantrum. What is a taper tantrum, you might wonder? Well, for those of you who know the history of the stock market, back in 2008, there was a big crash, and the Federal Reserve created a policy called the QE, or quantitative easing, which involved large purchases of bonds and other securities. So it basically increased liquidity in the financial sector to help promote economic growth. It basically tried to encourage consumer spending and business growth. So basically, it's just putting in more money into the economy. That being said, there are a lot of concerns that it's only a short-term fix and could lead to hyperinflation because a dollar would not be worth as much. So back in 2013, that's when the taper tantrum happened. The Fed basically announced that they would be reducing the volume of bond purchases, which was helping prop up the market. So of course, everyone panicked, but it turned out to be unjustified, as the market didn't really have a huge crash as everyone was expecting. Why, you might ask? Well, even though the Fed did announce that they will be slowing down its QE purchases, they actually instead had a third round of major purchases, around $1.5 trillion totaled by 2015. And they also publicly had a lot of faith in the market recovery, which also kind of eased a lot of people's mind. And then once the stock market investors realized that there really was no reason to panic after all, the market kind of settled down, and as you can see, it went up since then. So is today, 2021, is it going to be another overreaction, do you think? Or do you think this inflation is really going to cause a stock market crash? Are you currently pretty heavy in cash, like this Jim Tudor Jones, hedge fund manager? He's 80% cash. Are you heavily invested in the market right now? Do you have all your eggs in one basket? Are you diversifying? Are you in commodities, or are you in just the stock market? See, all these have to do with a trading plan, which we do go over in Pennybois University, as actually the basis of the university is creating a trading plan and learning how to use it to your advantage. So be sure to check out the free Discord. You can find a link to that in the description of this video. We do daily live trading on our premium Discord. You can ask any questions you have about, even this or any stock related questions in general during those live trading sessions. We also do 2 free live trading sessions on YouTube on this account. That's on Tuesday and Wednesday, 3 p.m. Eastern time zone. So be sure to like and subscribe for a chance to win 500 Dogecoin. We are giving away $500 worth of Dogecoin to a lucky subscriber once we hit 5K subs. We're also giving away $25 credit to your premium account for a Pennybois Stock Alerts premium account. We do that Monday through Friday, every single day, Monday through Friday, 3 p.m. Eastern time zone during these live streams. And today's winner is Keiku. Congratulations, Keiku. That's Keyku. So Keyku, make sure to message me, What the Duck, on our Discord, the Pennybois Discord, to claim your prize. And once again, congratulations to Keiku. And in order to enter these giveaways, all you have to do is subscribe to our YouTube channel. We're also giving away a 27-inch HD curved monitor, and all the details you need in order to enter that free giveaway is in our Discord as well. So make sure to check that out and ask about that. But until then, I hope that you all make some bread.